Good morning. I'm sorry for the delay. My name's Dave Hansen. I'm the chairman of the MIT Enterprise Forum in Houston, Texas. On behalf of the MIT Enterprise Forum and the Society of Plastics Engineers South Texas section, I'd like to welcome you all here today to a fantastic program. This is the 9th time we've had our program on the business forecast for the U.S. and the Houston area. We have always had the program at the Houston Business Federal Reserve Bank here in Houston. This is the first year that we've done it virtually, and I'm happy to say that we've had 379 people show up for this event, or sign up for the event. So it's going to be, I think, another great successful event. Usually when we've held it at the Federal Reserve Bank, it's been sold out. It's been actually sold out for the last 5 years. With all the uncertainty and turmoil in the news these days, it's our privilege to have Bob Charly as the moderator for our program today. And we also have 2 renowned economists, Bob Duca from the Federal, who's a vice president from the Federal Reserve, and Boyd Nash-Stacey, who's a senior economist at BBVA Compass. They'll be looking at what's been happening this last year and what we might expect to be happening this next year. Before we get started, though, I'd like to say a couple of words about the MIT Enterprise Forum. So I'm going to share the screen and start a slideshow here. Start slideshow. All right. One of our co-hosts for today is the Society of Plastics Engineers. I just want to point out that they're going to be having a virtual program like ourselves. They have a program every year, an international program on polyolefins. It's the biggest conference in the year in the world dedicated to polyolefins, and they're scheduled here for the end of the month. So I want to thank them for being a co-sponsor with us. Let me say a couple things about the MIT Enterprise Forum. We are one of 21 worldwide chapters that was started by MIT alums to give back to their local communities to talk about technology and entrepreneurship. Today, however, you do not have to be an MIT alumni to be part of our organization. In fact, I'm a good example. I graduated from Berkeley. I did not graduate from MIT, and I'm chairman of this chapter here in Houston. The kinds of things that we try and do are to have flagship programs like this program. We have new venture clinics where we have startup companies come in, present to a panel of advisors to help improve their presentations, particularly when they're getting ready to go out to investors. We typically help the student teams from Rice and University of Houston prepare for the Rice Business Plan competition every year. We also try to have networking socials. This year with COVID, of course, we have not been able to do that. And hopefully in another year, we'll be able to do that again. I want to say a couple things about upcoming programs. We've struggled this last year to figure out how we're going to do programs and to do it virtually and also economically, and to be able to accommodate more than 100 people to watch our programs. So it's taken us a while to figure that out, but we finally have done it by using a Zoom meeting and then streaming it to YouTube. As far as programs coming up this year, we're going to have Bill Higgs in March talking about company culture. He just wrote a book recently on company culture. We've had Bill present at the MIT Enterprise Forum in the past, talking about founding Mustang Engineering here in Houston. And they went from a startup company with 0 revenue to a multi-billion-dollar company. So it was quite a story. Company culture was a big part of making Mustang successful, and Bill's going to be talking about that in our next program. We're also going to be rescheduling our program with Houston Mechatronics. It's a great entrepreneurial story with some NASA engineers, robotic engineers, who started up a company to make underwater autonomous vehicles for the oil and gas and military industries. You'll be hearing more about that shortly. And the third program we have on the schedule is a program on SETI. That's a search for extraterrestrial intelligence. I heard a presentation at a UC Berkeley alumni meeting with Dan Wertheimer talking about this, and it was a very inspiring story, and it's something I thought that everybody would enjoy, is having an MIT program. We're also looking for other programs in the future that you can see kind of mentioned below some of our ideas. If you'd like to get involved in helping us put together programs or have a great idea for another program, please get in contact with me, and we'd love to have you be part of the MIT Enterprise Forum. I do want to point out that we've video recorded a number of our programs today, and we'll be video recording this program so other people can see it as well. Our most popular program has been MIT Professor Donald Sadoway. This is a joint program we have with the MIT Alumni Club. It's been over 40,000 views on YouTube. And Donald Sadoway talked about his work with developing liquid metal batteries for storing electricity on the grid. But we've had other great programs with Bennett Greenspan talking about starting his company, Family Tree DNA, the first DNA testing company in the world for genealogy. It was here in Houston, and he's Family Tree DNA is still one of the major 3 companies doing that today. We've had Rod Canyon talking about starting up Compact Computer. We even had a program in social engineering that was recorded and broadcast at Channel 8 TV here in town. I want to say thank you to our sponsors. Westlake Chemical has been a long-term major sponsor for us. James Chow, who's the chairman of the board for Westlake Chemical, is an MIT alumni and has been very supportive of us. The Houston Business Journal has participated with us for a long time as part of this program here, or this Business Forecast Luncheon, and also helping to promote the MIT Enterprise Forum in the Houston community. BBVA Compass has also been a long-term sponsor for us and participated in the Business Forecast luncheons. Houston Exponential, we've had a number of our programs at their facilities in their big auditorium there. The MIT Club, we've done joint programs with them in the past, and we appreciate that. Joe Guyman has been our photographer at many of our events. And Rice University, we've had programs at their facilities as well as collaborating with them on several programs. And the SETI program is going to be an example of one of the places where we are collaborating with them. So that tells you a little bit about the MIT Enterprise Forum. What I'd like to do now, I'm going to stop sharing my screen. What I'd like to do now is introduce Bob Charly. Bob has been in the media business for 34 years, and he's had major positions in New Orleans, Los Angeles, Hawaii. He joined the Houston Business Journal in 2015. And the day he joined, I think he started getting involved with the Business Forecast Luncheon program. So we really appreciate that. So without further ado, Bob, I'd like to turn it over for you to make some comments and to start the program.
Thanks so much, David, and welcome to all of our audience today. We have a wonderful event planned for you and truly 2 expert panelists. First, I'd like to thank the MIT Enterprise Forum for having me back. This is my 6th year as moderator, and I can tell you from previous forecasts, our experts are spot on. I think it's safe to say that 2020 was a year like no other. Unlike the crisis of '08 and '09, which was primarily a financial event, the year 2020 and the corona pandemic impacted all aspects of life as we know it, and it simultaneously impacted every corner of the globe. Almost overnight, tens of millions were out of work or furloughed, and it's estimated that hundreds of thousands of businesses have been lost forever or severely impacted as a result. The millennial and next gen population got a firsthand look at how our economies work in a crisis, government's ability to impact the economy with PPP and other financial measures, and the vulnerability of certain industries such as retail and restaurants to sudden changes in population habits. Add to the mix a heavily divided political and social year, racial unrest, protests, kids out of school, a new virtual universe for communications, and dozens more disruptions, and now a race to get the planet vaccinated in the last year has forever changed the lives of most Americans. I'm very pleased to share that HBJ turns 50 years old in 2021, and we have never been stronger. With now just under 1 million monthly readers, I'm very proud to say that we were a key provider of critical government and other information to businesses in 2020, as many of them struggled just to stay afloat. Thanks so much to all of you for your long-term support. Today, we're going to hear from two experts to make sense of it all and to help us gain insight into the economy ahead of us. This is our format for today. I'll introduce each speaker, and they will each speak for roughly around 20 minutes. After each has presented, we will open the floor to questions from you, the audience, to conclude the event. You may submit your questions at any time during the broadcast, and we'll try to get to as many as we can during our allotted time, and we're scheduled to conclude somewhere right around 1 p.m. So let's move on to our first presenter. John Duca is the Danforth Lewis Professor of Economics at Oberlin College, where he teaches macroeconomics, money, and banking, and is a part-time vice president at the Federal Reserve Bank of Dallas, where he conducts research in macroeconomics and finance. John has been with the Federal Reserve System for 35 years, the last 30 of which have been at the Federal Reserve Bank of Dallas. From 1986 to 1991, John was a staff economist at the Federal Reserve Board, where he briefed former Chairman Alan Greenspan and Paul Volcker and other Fed policymakers. Prior to joining Oberlin in 2018, John was an adjunct professor at Southern Methodist University in Dallas and was a part-time lecturer at the University of Maryland in 1990. He holds a BA from Yale University and a PhD in economics from Princeton University. Take it away, John.
Well, thank you very much, Bob. Okay, well, let me start off a little bit. First, it's a real pleasure to speak to the MIT Enterprise Forum, and thank you for your time and for coming. Today, I will present a national economic outlook. Of course, the views expressed, the views expressed are my own and are not necessarily those of the Federal Reserve Bank of Dallas or the Federal Reserve System. I need to say that, otherwise I could be a statistic in the next unemployment report and also lose my appointment to get vaccinated. Let me give you an overview of where I see the US economy. Employment and output contracted at a record pace last March and April, but there were strong monetary and fiscal policy responses. And from April to October, the economy had actually bounced back rapidly, but the pace of recovery slowed with the recent pandemic wave. We are still far from a full recovery. Growth in employment and economic activity has thus far been uneven across sectors of the economy and segments of the population. Now, the path of the economy is highly uncertain in the near term, as it depends a lot on the path of the pandemic. But the outlook is brighter in the second half of 2021. And I think we're going to be on the road to full recovery. As a road back for my talk, I'm going to first talk about the surge in the COVID infections and this pandemic and its impact. And then I'm going to segue to some of the more general indicators of economic activity, labor markets, consumer spending, giving you a view from 40,000 feet, and talk a little bit about inflation. I'm going to end by giving you an overview of what the Federal Reserve Open Market Committee's forecast was for the U.S. economy in December. It's a little dated, not too far out of date, but it's a pretty good forecast, and I actually, it is a good forecast, and I think it's a good way to present the views of the views shared by many people in the Federal Reserve System. Once again, everything I'm saying is my own opinion. So we've had a third surge in COVID, and it's had an impact on people's mobility and engagement. What I mean by that is, how often do you get out of the house? How long do you stay out of the house? Do the kids go to school? All of that has really affected things quite a bit. The third wave of the COVID-19 pandemic, we've seen, well, a lot of new cases around year end. Hospitalizations and deaths had surged from early October to early January. The good news is that this has been ebbing of late. Okay. We saw similar surges that began earlier in Europe that got reversed only after governments imposed very stringent lockdown measures. We saw quite a bit going on in the UK, and where they have a more transmissible variant of the virus. In the US, many states, after the surge in COVID infections after the winter holidays, we saw many states had reimposed tighter restrictions, and that caused mobility and engagement activity to decline, and that dampened the economic activity as well. Restrictions are easing of late, and that's a good thing. However, in terms of, it's a sign that we're able to, but we are dealing with a more contagious variant of the UK variant of COVID that's spreading across the US. And this is creating quite a bit of uncertainty over the next few months. That's the bad news. Now the good news. Vaccinations are increasing. They imply that the spread will greatly be slowed by the summer or early fall. A lot will depend on, once again, these new variants that are coming out. How effective are the vaccinations? How the public reacts? But I think the outlook is actually quite good in that respect. What I mean in terms of quite good, I mean that we'll try to get past this pandemic. I am not minimizing in any way, shape, or form the damage that this has done to so many people and families. I've lost friends, and I've had family members infected and and hospitalized. So for those of you who are going through that, my heart goes out to you. But I think, we're probably going to turn the corner. And one good sign was a few days ago, the number of people vaccinated finally started to exceed the number of people who have been confirmed cases of COVID. So these are good. These are indications that we're turning the corner. Let me show you some charts of COVID cases, hospitalizations, and daily deaths. Turning to the second from the left, the pink chart, you can see that daily cases are starting to ebb from the highs we saw shortly after the winter holiday period, right around here. Hospitalizations are starting to come up very, very high levels, which have really strained the public health system. Daily deaths are still, unfortunately, high, but they tend to lag behind infections and hospitalizations. So I think we may be turning the corner on this. Now, I should preface everything by saying, keep in mind, I have a doctorate in economics, but I am not a medical doctor, and I don't play one on TV. Now let's talk to you a little bit about the economic impact of COVID and how we can try to gauge that. My colleagues at the Dallas Fed have spent an inordinate amount of time creating what we call our mobility and engagement index. We basically take data on cell phone locations. These are anonymous data. So we're able to get some data about how the data index. And we see how things have changed since February. Now, the activity levels that we're seeing, we call it mobility and engagement, reflects both mandatory state restrictions, but also probably more important, the partial recovery that we've seen in the US economy. The data are available on the Dallas Fed's website on a daily and a weekly basis. Now, let me show you some of these indices. The blue line is our US index. So what we've done is we've indexed everything to be zero back in basically February. The lowest point, the blue line, is in basically late April. And we've indexed that to be 100. So that's the worst it's been. And you can see that mobility came back. The initial were imposed. And this is the third wave. Okay. And you can see that we're starting to bounce back. The red line is Texas, okay, which has behaved very similarly to what's happened in the US. The mobility and engagement in engagement with more and more people vaccinated. I think we're going to see some changes there. Now let me turn to some more traditional economic measures. Let me first talk to you about what happened with gross domestic product, real GDP. That's our broadest measure of economic activity. It contracted very sharply in the first half of 2020. So if you can follow my cursor, the black line is the actual level of GDP. We index that to equal 100 in the early part of the year. It dipped a little bit in the first quarter, and then it plunged. The dashed line is the Congressional Budget Office's, CBO's estimate of where the long-run sustainable growth level of economic activity or GDP is. And what this graph is showing you is that the level of gross domestic product fell basically 10 percentage points below its potential. This is a huge drop. But you will also see this sharp bounce back in the third quarter. It's not full. We're still below where we were, certainly on this path we seem to be on before the pandemic hit. And currently, we're about 2.8% below potential. And probably you could add maybe another 1 to 2 percentage points for where we would have been otherwise, absent the pandemic. Now, this seems to show a very short recession. However, once again, we still may face a long road to a full recovery. The good news in all of this is that you saw a very strong and rapid policy response from both monetary policy and also fiscal policy. What did the Federal Reserve do? Let's start on the left. First thing we did was we cut the overnight interest rate on the federal funds rate to basically near zero in mid-March. Now, basically, we can't push interest rates below zero, at least in the current conditions, and we don't have any plans to. But we also moved to lower long-term interest rates. And how we did that was we bought long-term treasury bonds, which helps push down interest rates on that corporations face for long-term investments. And we also bought large quantities of mortgage-backed securities to lower mortgage interest rates. And all of this has improved market functioning. But that wasn't enough. What we saw was that we were able to bring down the Treasury and the mortgage interest rates, but not as much the private mortgage rates in early March. So in addition to that, the Federal Reserve intervened in the corporate bond market, the mortgage market, the municipal bond market. We also helped banks, encouraged banks to make many PPP loans to small businesses. And we even have a program to help mid-sized businesses get bank loans. So we were trying to, we basically pulled out all the stops here. And I think that helped a lot. But it wasn't just the Fed. We saw a tremendous, if we turn to the right column, we saw a tremendous response from fiscal policy. Over $3 trillion in fiscal support for businesses, households, and state and local governments. The CARES Act and the CRA Act, we saw stimulus checks being sent to households. We saw extended unemployment benefits to help people survive the unemployment coming from this pandemic, which they basically was out of their control. And also, a lot of funding for the Paycheck Protection Program, which has helped keep a lot of businesses afloat. One of the key strategies with all of this is that we're trying to keep businesses open, at least functioning, so that when the pandemic is over, they're able to rehire people and ramp back up. We let a lot of businesses fail because of this pandemic. It will be very hard for them to form new companies and get everything going again. It seemed crazy to allow that to happen. And you saw a very strong response from both fiscal and monetary policy. In addition, there have been forbearance on mortgages. A lot of mortgages have been modified to prevent the sort of problems we had after the subprime crisis. And of course, student loan payments were deferred. I'm going to skip that slide. Let me talk to you a little bit about what's happened with fiscal policy relief and how important it's been. The green line shows that personal income, absent federal transfer stimulus checks and unemployment insurance, fell by about 7% below February levels at one point. And it's slowly come back. Now remember, this doesn't adjust for inflation and for population growth over this period of time. The gap here, the blue line shows what if, let's add in the stimulus checks, the unemployment insurance, and you see that fiscal action has really helped households overall keep incomes up. This has helped prevent consumption spending from plummeting. The dark blue line here is total personal consumption expenditures on everything from services to goods. This is a very broad measure. It fell basically 17% from February to April, but it's come back quite a bit. And then it's been stymied about 3% below the pre-pandemic levels. Now the mix is very interesting here. Typically in recessions, we see people postpone goods purchases. So goods purchases, the green line, fell, not as much as overall, and then it's really recovered. It actually exceeds levels seen before. Why is that? Well, people can't go out. Service spending fell really strongly here, really roughly 20% to the trough here. And it's come back some, but we're still roughly about 7% below. So basically people are staying at home. They're ordering goods from Amazon and all the other online retailers. And they're also seeing low interest rates that have encouraged them to buy and other big ticket items. Another interesting feature of this recession is what's happened with single family housing starts. They fell, and this is indexed to January, February levels. They fell roughly 30% through April. Okay? People got scared. They were worried about their jobs. The brakes were hit, but then people saw very low mortgage interest rates, Federal Reserve has really pushed long-term interest rates lower. And we've seen housing start to greatly exceed their pre-pandemic levels. So this is part of how monetary policy stimulates an economy through the housing markets. Now let me turn to the labor market. This is a chart of what we call total non-farm employment. This is payroll employment. These are people employed by firms and firms and government. And you can see that we fell a lot in the Great Recession, recovered, we had a strong recovery, an expansion, and then we plunged. We lost, at one point, we saw 22 million jobs disappear. The good news is we got a lot of them back relatively quickly as the pandemic restrictions were eased and people went back to buying goods and to going out into the economy. But we're still about 10 million short as of February, 10 million below this level here, 10 million in absolute numbers, 6.5%. So we still have a ways to go in terms of a recovery. Now let me show you the unemployment rate. That's the black line. This is a 3-month moving average. You see that it typically surges during these shaded areas, which are recessions, and then it peaks shortly after a recovery, and then or shortly after a recession, and then comes down. And this is where we were just before the pandemic hits. We surge quite a bit. We come down. Now, this is the 3-month moving average, so we're smoothing out some of the unusual wiggles. But we still have a long way to go. And I would also add something here that this unemployment rate figure probably overstates how much we've recovered because about 2% of the population, particularly women, have dropped out of the labor force to basically watch school age and younger children at home who can't go to childcare or to schools. So this decline probably overstates things a bit. If you adjust for people who dropped out of the labor force, we're probably somewhere around here. We've come down, but we still have a long way. We still have a ways to go. At one point, the unemployment rate jumped 10 percentage points in 1 month. That's unprecedented. And we have basically, usually, right now we have about 30% on temporary layoff, but it was almost 80% in April. Usually in recessions, we typically have more permanent job loss and less temporary layoffs. So it's been a very unusual recession. Finally, consumer spending usually falls a lot on durable goods and non-durable goods and housing, and typically falls less for services. We actually saw the exact opposite. That's how unusual this recession's been. Let me turn to inflation. Our measure, we have 3 measures of inflation here. These are all based on broad consumption, which we call personal consumption or PCE expenditures. The red line is the overall rate of inflation. It plunged a lot. A lot of this was declines in gasoline prices and other items. If we exclude food and energy, we get a little less of a drop in inflation. The Fed wants to keep inflation around 2%. The dark blue line here is the Dallas Fed's trim mean or trend inflation rate. That's dipped a little bit less because there's some unusual downside outliers here. But we see a modest fall of inflation. Part of what to think about with this recession is both demand and supply have contracted. So even though we have a lot of unemployed, we're not getting as much downward pressure on inflation as we normally would. Now let me end by talking about the outlook from the Federal Open Market Committee. This is an outlook that the Federal Reserve System put. Basically, this was the forecast that the committee made in December that was released with the December, shortly after December. What does the outlook tell us? The black line here is GDP growth, okay? And this is annual. You can see this is quarterly. You can see the big drop in the first quarter. You can see the recovery. And basically what the Fed is looking for is growth basically this is year-over-year growth, to accelerate to about a 4.25% by the end of this year. And then as the economy gets closer and closer to its potential, that growth rate will trail off. This was actually probably a little bit above what private forecasters were seeing were viewing back in December. Since December, the evidence has come in very positively, and more and more the private sector economists have become a bit more optimistic. If we look at the unemployment rate, right now we're at 6.7. The Fed projects that it will come down to about 5% by the end of 2021, 4.25% by the end of 2023, and about 3.7 by the end of 2024, which is roughly where we were before the pandemic. So this is a fairly a view that we're gonna come back. Okay? Now, precise pace could vary a bit depending on the pandemic and the vaccines and all of that. But I think this was a fairly, I think, optimistic view. I mean that in a good sense. And I would say that since this forecast was made, the numbers have probably been a little bit better. So I think that there is some cause for optimism. That said, of course, there are going to be upside and downside risks. Let me turn to inflation. Inflation was running around, this is overall inflation, a little bit below 2% just before the pandemic hit. It's basically slowed to about 1.25% by the end of 2020. The Fed is projecting that there'll be a recovery towards 2%, 1.8% by the end of 2021, 1.9% by the end of 2023, and roughly 2% by the end of 2024. Let me talk to you about the upsides and the downsides to this outlook. Oops, bear with me here. Let's talk about the downside risks. First, well, there are these new strains of COVID-19, the UK variant, the South African variant, and now a Brazilian variant. God knows what could come next. All kidding aside, that could delay the recovery. The other thing that is a concern is that there are scarring effects from this pandemic. There's the human toll, the loss of life, lingering health issues, mental health. I think we see a lot of stress on families. The divorce rate surged a lot, for example. Children are not being, mistreatment of children has been a little bit elevated, unfortunately. And people have been feeling it. The education of our young has been hampered. There's a big burden on parents, especially mothers, to homeschool children. My spouse and I homeschooled both of our sons till they were 13. We did that out of, because we wanted to give them a particular education. They were very strong, self-starting kids. But I can tell you from firsthand experience, it took a lot of effort on our part. So I feel for families that decide to do this. And finally, there are going to be lags, and we've lost a lot of service firms. There are going to be lags for these new service firms to be created to replace those closed by COVID. The other thing is we've had people unemployed for a while, and it may take us a while to maybe retrain or move people from different sectors that may not come back to pre-pandemic levels. That's the downside. But I also want to talk about the upsides. And I personally, I'm probably a little more on the optimistic side than most people. First, we've seen progress in overcoming the initial slow vaccination rollout. Prior to this blizzard that seems to have hit the Northeast, we were up to roughly 1.3, 1.4 million vaccinations a day on a 7-day moving average. That is that's a good pace, and people are trying to raise that even further. Second, we didn't see the traditional or typical recessionary dynamics kick in that would drag the economy down with these sorts of levels of unemployment. Part of it was that the Federal Reserve stepped into the corporate bond and municipal bond markets, and the Treasury and the Fed helped maintain bank lending to small and mid-sized businesses. That, I think, is going to be shown with this history, retrospectively, is going to be shown to be incredibly effective. I've actually done some work on that. We also saw, coming out of the first round of COVID, the first wave, a rapid bounce back. Okay, and that would suggest that after we get beyond, after we turn the corner on this pandemic, finally, that there'll be a rapid bounce back as well. Personally, I think a lot of people would love to go back out. A lot of us would like to go on vacation. A lot of us would like even to see our in-laws and other family members. All kidding aside, I think there's a lot of pent-up demand for people to go out. We've been cooped up for too long. I mean, we've had cabin fever for a year, and so I'm optimistic that way overall. Finally, I think this is really important. We had such tremendous fiscal and monetary policy responses, very fast, very big. This buoyed spending, bolstered wealth, and tamed concerns of the downside risk. So in conclusion, COVID and all the associated containment measures caused a huge economic shock. We saw employment and output contract at a record pace in March and April, but we saw rapid and strong, very aggressive monetary and fiscal policy responses. We've had a strong recovery since May of 2020. We've seen a large rebound in consumption and housing, but growth likely moderated near year end, at the beginning of the year early, recently due to the resurgence in COVID cases. We're still far from a full recovery. We're on the road to recovery. We have a ways to go. And I think the policymakers understand that. And I think we're gonna probably see that. Now, that said, we're gonna see, we have large uncertainty over the next few months. The path of the recovery, the pace, is gonna depend a lot on the pandemic and how quickly we can get vaccinated and get on top of all this. I would say that the outlook is very bright for the second half of 2021. Usually when an economist tells you to be optimistic, that's a good sign. But once again, there are upside risks and downside risks, but I wish you all the very best, and I'm looking forward to a continued recovery in the end of the pandemic. And let me conclude by saying something else. The US economy suffered a very serious recession after World War I. We had the Spanish flu pandemic. 675,000 Americans died from the Spanish flu pandemic that occurred in 1919 and 1920. It's a lot of people. We entered that decade with a deep recession and a pandemic. And yet the 1920s were a period of rapid growth. And that would suggest that we can come back and that we are not necessarily going to have another lost decade. I think there's been a strong policy response to overcome that. We have new technology. Many of us, I think if anything, the pandemic has encouraged us to more rapidly adopt all this new information technology, this wonderful ability to connect virtually and visually, like we are right now, and that could help us. So I would say there's good reason to be optimistic in the medium term, even in the near term, and in the long term. And with that, let me turn it back over to Bob. Thank you.
John, thank you so much. Well done. Folks, please submit your questions. You can do so in the bottom right-hand side of your screen. We look forward to answering as many of those as we can. Our next speaker is Boyd Nash-Stacey. He is a senior economist with BBVA Research in charge of U.S. macroeconomics analysis and economic scenarios. He joined the BBVA in 2011. His research has focused on factors driving the slowing prime age labor force participation, the impact that lower oil prices have on the regional economies, how financial inclusion and access to financial services impact local economies, and how millennials stack up against their generational cohorts. His work has been featured in Bloomberg, Wall Street Journal, Consensus Economics, Business Weekly, Business Insider, American Banker, Texas Monthly, and of course, the Houston Business Journal. Let's welcome Boyd. Take it away.
Thanks, Bob. It's a pleasure to be here. I know it's under unfortunate circumstances that this has to be in a virtual event, but I think this is part of the new normal. So the way this works usually is that we start, with a global perspective and then kind of work our way down. But, in this case, the pandemic really is the overriding factor influencing the economic outlook. So we'll quickly do a recap. John has done a fantastic job catching you up on, the kind of high level macro trends. So hopefully we'll take a little bit deeper dive, give you some perspective on kind of the sector specific shocks. But then talk about the outlook. And I think I echo John's sentiment that there really is a case for optimism. The policy response has been significant, timely, and I think that there is a growing consensus that fiscal policy does have a place. And I think that obviously this pandemic has presented a scenario where fiscal policy really has a place. So again, then we'll talk about the regional outlook and how we see the pandemic evolving and its impact on the local economies, and give some perspective on the local economy for the year. So this is kind of the way I try to kind of think about the universe and the impact that the pandemic has had on the U.S. economy. And so just to give you some perspective on this chart, if you look at the bottom, you see openings, and this is job openings relative to the pandemic peak or the reopening peak in the summer. And you can see that anything to the left-hand side of the chart would represent a decrease in the number of job openings, meaning a decrease in the demand for workers. Anything above that would obviously suggest some kind of increased expectations for demand and obviously for more workers. And then on the left-hand side, we have kind of where the sectors are in terms of overall employment relative to the pre-crisis peak. And there really are a few standouts. State and local governments continue to be extremely adversely affected by the pandemic, with a drop in economic activity, and that being a major source of revenue for these governments. We've seen a major pullback in overall employment, and obviously in impacting the broader economy. And then you kind of see the traditional areas where we've focused on during the pandemic: arts, entertainment, and recreation, restaurants, sporting events, and the like, and then accommodation and food services. Obviously, hotels and restaurants being impacted by the voluntary and compulsory distancing measures implemented by some governments. So again, you can see it's definitely a different world for some sectors, whereas other sectors, when we think about durable goods manufacturing, autos continues to be an area that's seen, very strong demand in the post-pandemic period. But then we also see, structural trends that are being accelerated, and professional business services is a good representation of this. In this category, think, engineers, computer scientists, economists would fall under this category. This has been an environment where these skills are in high demand, and you can see that most of these sectors are only slightly below their pre-pandemic levels. And then you also think about transportation and warehousing, and the shift to online purchases and reduced in-store activities, particularly in the retail sector. And you see this is another area where we're only slightly below the pre-pandemic position, with a high demand for new workers. And obviously, this is a function of the mobility trends. John, again, mentioned some of these trends, but when we disaggregate these mobility trends, you can see that there's really kind of two worlds, right? I mean, there's been a shift, obviously, to more demand for car transportation or driving in this case, and also walking, which has been kind of a pandemic trend in terms of trying to improve, health outcomes and fitness levels and everything like that. I was also a part of the bike trend that was very strong in the early part of the pandemic. So again, this is kind of the nuanced world of the pandemic, where we see very strong recoveries in areas like driving and walking. But on the other hand, we see areas like mass transit still remaining well below the pre-pandemic levels. And unfortunately, at this point, there isn't a strong likelihood that this sector, or the transportation sector, can fully recover without a mass vaccination, a successful mass vaccination campaign, and something close to herd immunity. I know this is a term that's being thrown around a lot. I want to emphasize that herd immunity doesn't mean eradication. And I think even in a world where we do have herd immunity, there still have to be precautions put in place that could impact this sector, or keep it below its pre-pandemic potential, but will obviously some conversion to kind of that pre-pandemic normal, although that could take longer than anticipated, especially with some of the new variants of COVID-19 that are surfacing around the world that have the potential to minimize the effectiveness of the vaccine. And then when we break it down from the national accounts perspective, so that was the labor market before, and this is kind of the overall expenditures when we're thinking about economic activity. And on the consumption side, it's been fairly positive, although there's been obviously differences among certain sectors. Obviously the durable goods or the tangible items, when we think about autos, clothes, recreational goods, those are areas where we've seen a pretty significant rebound, and in some cases to a level that's above the pre-pandemic or the pre-crisis. So on the right-hand side, this is that kind of dual representation, which is both the recovery from the initial shock in the first quarter, and then also the kind of position that these sectors are in relative to the pre-crisis. And you can see that there are a handful that are either right at that pre-crisis level, or significantly above when we think about recreational goods and this shift in preferences brought about by the pandemic. The investment side has been a little bit of a mixed bag. On the other hand, we've had some areas, like I said, that have recovered strongly. That shift to teleworking and the demand for office equipment has produced a significant rebound in equipment and a lot of other categories within that segment. But you can see there's other areas like healthcare, where we're still seeing things remain below that kind of major shock that we saw in the first quarter. Mining is another area where the kind of long-term structural headwinds that were facing the oil and gas sector prior to the pandemic, plus the unprecedented demand shock brought about by the pandemic, has led to a very weak environment for investment for the mining sector. However, I think this is an opportunity. I've been doing this for about 6 years, and it feels like every other year I'm presenting a positive or negative outlook. But in this case, I think with the recovery in prices and the fact that with more successful vaccinations, and as more of the population becomes either immune through infection or vaccination, that there will be increased travel. And you see that because we had experienced what was a pretty significant contraction in supply and investment, that the outlook for prices should be consistent with a level that could encourage some domestic production, even considering some of the changes in policy that are likely to come about from the new administration. I think that tends to be overstated when we think about drilling, particularly in Texas. The production on federal lands in Texas is a very small share of overall production. So again, I think this is something that's going to maybe benefit Texas relative to other states that have a high share of drilling done on federal lands. But nonetheless, I think the important thing to keep in mind is that short-term decisions, in this case, the reduction in supply that occurred last year, is going to not impact the short term, but impact the medium to long term. And I think this is where you have the positive demand trends meeting what could be a smaller overall stock of petroleum products, could lead to a fairly stable outlook for oil and gas. Now, obviously, as I mentioned, there's structural headwinds in terms of sustainability push, not only from the new administration, but also from the private sector in terms of increasing the sustainability or the potential of the US economy. So those are going to still exist, but I think the kind of short-term fundamentals in terms of supply and demand should be in favor of a strong rebound. Moving into the outlook. Again, I think John did a very good job, so I won't go into too much detail in terms of the case levels, but you can see that this isn't a phenomenon of the US in terms of the rising cases. Obviously, the variants are now differing across countries, where we have the South African variant, the UK variant. There's been some discussion on a potential variant that's been found in California. But despite the virulence of these new strains, overall case levels are rising. And I think that this is more of a function of the behavioral response and the lack of appetite for sustained distancing measures, both in the U.S. and in Europe. So the situation looks pretty bad from a case level perspective, but when we think about outcomes, the improvement in the healthcare sector with treating COVID-19 and the therapeutics available, and then also with the focus on vaccination of the most vulnerable populations, has led to better outcomes when we're thinking about deaths and hospitalizations. And it seems, as we've learned about this virus, that it's not necessarily the stock of cases or the new cases that's important. It's really tipping points, and those tipping points are relate to the capacity of the local healthcare sectors. I'll touch on this a little bit later, but El Paso is a good example where they basically surpassed that threshold, forcing a major shutdown of their overall economic activity, given the pressures put on the healthcare sector and the lack of additional beds for intensive care patients. But again, the good news is that the vaccination campaign continues to progress. If we think, in terms of the available vaccines with the mRNA technology and, needing 2 doses to reach a fairly high efficacy rate, we're still, well behind in terms of where we need to be for herd immunity. But I think, what I'm seeing from the current administration and the emphasis being put on the vaccination campaign, I think that the outlook is positive. Again, that is with the uncertainties associated with new vaccines and the risk that the coronavirus mutations render one of these vaccines ineffective. But I think with I think one thing that I think is being a little overlooked is that the Johnson & Johnson vaccine, which is a much more traditional approach to vaccination, has the potential to really, I think, at least buy more time this year. The logistical restrictions or the impediments in terms of cold storage are much less of a problem with the J&J vaccine. Efficacy rates are obviously lower than the mRNA type vaccinations. But that being said, they're showing, in the range of 70%, which is consistent with most flu vaccines. So that in and of itself, and the fact that they can reach scale very quickly, I think could be or could allow us to get to the end of the year with maybe not, people, reaching the efficacy rates associated with the mRNA vaccines, but I think the scalability is what's really going to be important with that vaccine and vaccines of that nature. And then when we think about, obviously the kind of the short-term risks for the pandemic, there's also that policy tailwinds, brought about by the CARES Act. We had the year-end fiscal stimulus in December, but now we have an administration that's very focused on expanding that support. Right now, the proposals, around $2 trillion. There's been a counter proposal from the GOP that's under $1 trillion. I think the one disadvantage in this case, in terms of the size of the fiscal policy, is that there has already been some compromise. So I think the incentives, especially on the GOP side, to to kind of go for the largest potential rescue plan isn't likely. But that being said, we're still expecting significantly more stimulus this year, and then with even an upside potential from the any kind of infrastructure bill. I know that's going to be a focus in addition to many other things, like Made in America and sustainability, the rebuilding of America's infrastructure, which obviously is in sore need. So just to give you some kind of scenario analysis in terms of where we were thinking and where we think things could be. This chart shows US real GDP growth rates in 2021 and 2022 with our baseline. This is BBVA, so we use quite a few blues. I apologize for that, but if you kind of work your way up the baseline to the kind of the highest segments of the bar chart, that shows the incremental benefit from each of those stimulus packages. So just to give you some sense of where we would be with the existing fiscal stimulus, would be around 4.5% of GDP this year, with major upside next year if we do get stimulus either in the first or second quarter of this year, or even if it carries into the second half of the year. And again, I think that what's important here is that this analysis uses fairly standard fiscal multipliers, as we call it. So basically, how much of the stimulus goes back to economic activity. And I think in this case, with the tweaks to the individual policies that should direct the resources to the people that are the most in need, means that it's going to circulate throughout the economy much more quickly. So I think really there's more upside to 2021. And I think right now, going into this year, we were thinking maybe growth rates around 3.5%. Now we're thinking growth rates this year with the additional fiscal stimulus likely to happen in the next month or so. We'll push growth rates closer to 5% this year. And then again, depending on kind of the timing of the impact, we could see growth rates around 5% next year. And so what does this mean in terms of returning the economy to that kind of pre-pandemic level, or making a full recovery? You can see that with the different scenarios, you get very different outcomes. Kind of, if you think about our baseline scenario at the end of last year, would have implied a scenario where we never return to the pre-pandemic growth path. This is very similar to the global financial crisis, and has led to many persistent drags on economic activity, particularly in the labor market. Now with the December stimulus, we get closer to that pre-pandemic path, but again, without that additional push this year from the administration or from fiscal policy, you don't get back. However, with that stimulus, even if it's close to 1 trillion, in this case, you reach that pre-pandemic path by 2022. So basically closing what we call the output gap and putting you in a position, no worse off in terms of the pandemic from an economic perspective. Now, if we get closer to 2 trillion in stimulus, you can see how much of an overshoot we get in terms of the pandemic. Obviously, there's implications from growth rates this strong, primarily being the Federal Reserve and the reaction or the reaction that this may necessitate from them, both from an inflation perspective, but also from a labor market perspective. Rates could rise faster, but either way, we're headed on a very, I would say, optimistic trajectory, particularly where we saw things in the pre-pandemic. I know the Economist jobs, right at the beginning of the pandemic was to, come up with creative names for the shape of the recovery. And I remember the most creative was the swoosh, the Nike swoosh. But based on this, we're not close to that swoosh, or bathtub was another one that I've heard, where you have basically a U shape. We're really on a V shape with maybe I would consider maybe a stall with a very strong recovery after that. So things are looking very, very positive when we think about overall U.S. growth. And then in inflation, I won't take too much time here, but I think the market consensus that there was some major risk of a heating up of inflation in the short to medium term isn't necessarily the case when we look at the data. We think about there's two ways to think about this from an expectations perspective. In this case, this is market expectations, you see that, there was a pretty substantial rise from kind of the worst period of the pandemic in March, but it's really consistent with, inflation expectation rates that prevailed between 2016 and 2019, in which case we didn't see any kind of major inflation rates that were, what we would consider not within the control of the Federal Reserve, around 2%. In fact, for that period, inflation was persistently below 2%. And then when we think about it from an individual component perspective and how that contributes to overall inflation, the right-hand side chart is a diffusion index, meaning that above 50, more than half of the categories, in this case, it's personal consumption of around, it's 109 categories, are running above kind of the average. And so you can see that, there has been some increase, as John alluded to. This is both, a function of weak demand and weak supply in specific categories, but it's not consistent with any kind of runaway inflation that we saw in the 1980s. So then when we think about the Fed, there is the potential for, a pickup in inflation when we do see, demand bounce back potentially in the second half of the year. But we're thinking about kind of the new objectives of the Fed and this goal of reaching not necessarily long run employment levels, but maximum employment levels. We're still a ways away. By the chairman's in the chairman's press conference, he was asked about this. There was, a lot of questions about, how soon could you, taper balance sheet purchases or raise rates? And, he pushed back very strongly against both, and said that, basically, the idea of even being close to maximum employment would mean 9 million more jobs. So if you think about that chart I just showed in terms of, kind of the baseline upside with fiscal policy, our previous baseline had this happening in around, second half of 2025. So again, a long ways off. Now, with the stimulus, we should see, stronger inflows back into the labor market, and with some of the policy objectives of the Biden administration being very focused on labor, we could see even, more improvement. But I think even in an optimistic scenario, we're still looking at 2024, and I still think that's optimistic. Again, the CBO just released their forecasts, and their the output gap doesn't fully close until 2024, which again would be something that was consistent with past tightening and kind of the standard Taylor rule. But again, now with the strategy focusing on average inflation targeting, meaning being less sensitive to inflation over 2%, and equally less sensitive to inflation running slightly below. Again, this suggests that things may take longer than kind of the traditional models would suggest. Right now, we're thinking 2025 for the first rate increases, but with that additional fiscal stimulus, I think that could be potentially pulled forward maybe to 2024. But this market idea that we're going to see rate increases in the near term, meaning within the next year or two, I think is a bit premature, especially with this new policy framework with average inflation targeting and this maximum employment idea. And then when we think about long-term rates, again, this was another unusual trend towards the end of the year. In the beginning of this year was the major uptick in long-term interest rates. We still have massive bond buying by the Federal Reserve. So the idea that we would see, a major upswing, based on any kind of demand shocks is unlikely. And then again, supply, the deficit financed fiscal policy will lead to potentially higher rates, but with the Fed being such an active participant in the market, that's not necessarily a near-term concern. Again, I think some of that, and this is not a chart that I show in this presentation, but there was some evidence that the strongest uptick at the end of the year and the beginning of the year was driven by uncertainty and the premium investors put on holding these long-term securities, which correlated very closely with institutional risks and the capital riots. So again, I think there was the potential concern within the markets that this type of, or if this persisted, that this would represent some kind of geopolitical risk premium in terms of holding U.S. government debt. But that seems to have subsided, and you can see from the data, we are seeing things start to slow down, but suggests a lower for longer scenario. And so I only have a few more minutes. So I want to touch on the local economy before we wrap up. Again, the outlook for cases is still, fairly negative in most major states in the country. Think about California, Florida, Texas, New York. Obviously there's still very high case levels on a per capita basis. But as I alluded to earlier, when we think about this in terms of deaths, you can see that, although, we are seeing, deaths rise, it gives you some perspective to see the peaks that we saw in April and May, where we had no ability to, remove vulnerable people from the population or have any kind of, immunity from, infections or vaccinations. But again, it's still headed in a direction that's worrisome, especially if it begins to put pressure from health on the healthcare of local economies. And then, RT, if we think about this, I'm not sure if everyone's familiar with this tool. It's basically a measure of the infectious rate within a community. If it's close to 1, basically it means that there's going to be no acceleration in the case levels. Anything below 1, you would see accelerating case levels. Anything below 1 would be a deceleration in cases. Anything above 1 would be an acceleration. So you can see, we've gone through kind of, hotspots or periods where each state has kind of had their worst, but now you can see that, some areas are experiencing fairly high RT or effective reproductive rates. But overall, most areas are either green or kind of light green, suggesting that, it's not in a very negative environment. And the more important point that I want to make is what has become a less burdensome economic cost with lowering the reproductive rate. So what we know now from COVID-19 is that this is a very infectious virus. It as I heard from an epidemiologist, it's not seasonal, it's opportunistic. So if we give it the opportunity to spread, it will spread. So if you think about the effective reproductive rate, to achieve anything below 1 requires some kind of intervention. It could be at the individual level, but in most cases, it requires some kind of outside intervention to lower that below 1, meaning to suppress the virus. But what's interesting is if you look on the right-hand side at the red line, that is the relationship between the change in growth and this effective reproductive rate. So basically it represents the cost in economic terms. And what you can see is that line has flattened over time. And one way to interpret that is that, even if there is an effort to reduce the virus, the economic cost of that reduction has become less. And if you look at the most recent quarter, this would be the third quarter on the far right, you can see that there, like states like Arizona, have had to implement pretty significant distancing measures. They still were able to see fairly high growth rates. Again, this is correlations, but I think it gives you a general sense of the lower costs in economic terms of this kind of living with the virus. And then with Texas, this is again an area where I think that benefited from a policy perspective economically, with the lower, I would say less in a relative sense, the less restrictive distancing measures. However, the acute pressures on the mining sector that were partly related to the pandemic, but also were a function of kind of uncertainty heading into the year and some of the structural headwinds with the sustainability, saw growth fall right in line with the U.S. average at around minus 3.7%. I think if you take out that oil shock, you would have had higher growth in Texas based on some of the other results we've seen from states with similar distancing measures. But those kind of dual shocks led to a fairly consistent growth rate or contraction in growth in the U.S. and Texas. But next year we see that rebounding very quickly. Again, getting kind of that bounce out of the pandemic. And then, with the upside from additional fiscal policy, we could see growth rates, again, closer to 6%, as opposed to our current forecast, which is around 4%. So again, optimism high for Texas as well as the US. And then when we're thinking about kind of the local level, we'll drill down a little bit more with Houston. Again, you can see on the right-hand side, this is the unemployment rate for Houston, the US, and then our forecast. You can see that there was there has been quite a bit of divergence between the Houston unemployment rate and the US. Yeah, again, partly owing probably to the mining sector, but also partly owing to the rising case levels in Houston. We expect this to converge rather quickly, and especially with that outlook for the mining sector improving, we could see things start to accelerate here rather quickly. But I think, when we think about kind of the longer term structural headwinds, Houston is still in a position where it needs to adapt, and I wouldn't say move away from the mining sector, but come up with a strategy to incorporate sustainability with the kind of energy focus of Houston if it is going to continue on that recovery path for the next decade or so. Again, I think that that's it for me in terms of the presentation, and I think we have a few minutes left, so I'll kick it back over to Bob, and then we can take questions if we had any come in on the chat.
Thanks so much, Boyd. Great job. Really appreciate it. And thanks to our audience for hanging with us. We're coming up on the hour, but we've had some submitted questions here just in the last several minutes. Let's try to get to as many as we can for panelists. Let's keep these answers short so we can try to get to as many as we can in maybe the next 10 minutes or so. First one is, and this would be for both of you guys, what about the federal debt and deficits? Can we ignore those forever? Who wants to take a shot?
Well, as the younger member of the
Well,
panel, I will say that it's definitely not an immediate concern, but I think there's obviously long-term consequences for high debt levels and indefinite deficit spending. That being said, I think this is the example, unlike the global financial crisis, where fiscal policy has a place, and I think that the attitudes towards fiscal policy, as I mentioned, have I think been altered a little bit by this pandemic. So I think now is the time to spend. We also have record low interest rates, so the overall cost of these policies is extremely low. And then when we think about needs, particularly in infrastructure, I think that there's pretty general consensus that any spending in those areas will be paid back in the long run. So I think, again, in the long run, yes, obviously it's a concern, but in the short run, I think pedal to the metal. I think once we get out of this, we can revisit that as a country. But in the meantime, it's about getting out of this.
John?
I generally concur with those comments, and I would point out that traditionally in the U.S., the federal government has borrowed a lot during wartime. We have lost more people to this pandemic than we did in World War II. And I mean, that's a sobering thought. And I don't think we really have much choice except to stimulate with fiscal policy. However, we do need to be mindful down the road that we have accumulated a debt. This is one of those cases where future generations are going to have to service a debt. However, had we not borrowed, there may be fewer people in those future generations as well. And this is just one of those cases of a national emergency. That said, I would also say that I think the outlook has firmed quite a bit. Prospects for fiscal policy have further action to help get this economy going again are there, and that is also another factor that has improved the outlook since January. Thanks.
Okay, next question. The stock market is at record levels. Is it overvalued? What is the risk of a big market correction and negative economic impact?
Well, stock markets typically react positively to low interest rates and are based partly on expectations of future growth. And to some extent, those things have buoyed stock prices. And those things are longer run factors. Whether or not the market is overvalued or undervalued, I really can't, I'm not allowed to really say. I'll turn that over to Boyd.
Yeah, I mean, I don't It's a difficult question, right? Because as John mentioned, there are many factors that would, I think, positively impact stock prices in terms of fiscal policy, the fact that in relative terms the U.S. is in a much better position than other areas of the world, global economy. I think there is also kind of the phenomenon, I should say, that we have had massive fiscal stimulus, a lot of which has been transferred to people with middle incomes to high incomes, and so a lot of that I think has been put into the stock market. So I think that I don't necessarily think that overall that suggests an overvaluation. I think what it does imply, and I think what we've seen with the GameStop and some of these other areas, that it could increase volatility and create some areas where or uncertainty in the market that hasn't been there before.
Okay, guys, it looks like we have two energy questions. John, you may not be able to comment on the first one, but here goes. What is your opinion of the impact of the executive order shutting down the Keystone Pipeline, stopping drilling on federal lands, and other regulations that are being implemented on growth in the U.S.?
I guess I'll take
You'll
that.
have to
I
take
have to
this one,
say,
Boyd.
I'm not an expert on the Keystone Pipeline, but I remember there from the Obama days, a lot of the studies surrounding the construction of the pipeline and the number of permanent jobs associated with that construction was very small. So canceling the pipeline from a long-term perspective or from an economic perspective is not significant. From an expectations perspective, I think that's where you could see the administration's focus on energy negatively impact investment in the U.S. But the federal lands question, I think that's another one that's a bit nuanced, right? In Texas, there's very little of the drilling occurs on federal land. So in terms of the pure the restrictions in and of themselves shouldn't have a huge impact. Again, other states like North Dakota, that could have a huge impact. So again, it's going to differ, but I think really where the biggest shock is going to be on expectations, and if firms are comfortable with investing with this type of policy environment.
Okay, this one sounds like it's a little more specific about natural gas. Do you have a forecast for oil and natural gas prices in 2021, 2022, and its impact on the economy? I think it's sort of a consensus, 22 and beyond is when we'll see the real rebound. So what do you guys think about, the traditional oil and gas and natural gas?
You want me to take a stab at this one?
I'm going to have to defer because I'm not allowed really to forecast commodity prices.
Okay. Well, we don't have a point forecast anymore for natural gas. But what I can tell you is we did do a pretty in-depth study on natural gas and the potential for investment here in the U.S. And what we found was, I think there is a strong likelihood that it remains the bridge fuel to other renewable technologies like solar and wind. There is a risk that underinvestment up to this point, and some of the supply bottlenecks that can be associated with natural gas means that kind of focusing the U.S. on this sector for the long run may not be as viable, and as such, we should see prices remain low, given that supply is going to be fairly stable. In terms of oil, again, I think this is a difficult question. I mean, the U.S. was reaching production levels that it hadn't seen in many decades. And I think, with the pandemic easing, we should see prices start to rise. But the long-term structural headwinds as a result of sustainability initiatives, as I mentioned, in the private and the public sector, mean that it's going to face challenges. And I think the risk is that it becomes kind of susceptible to the ebbs and flows of the political cycle. So again, I think this is, obviously it's a sector that's going to be strong and important for the U.S. in the near term. But again, there's definitely long-term structural challenges that the industry is going to face.
I'm going to translate this one a little bit. Essentially, the question is, by your data, it looks like you're predicting a positive outlook. I think the question is, by large, medium, and small businesses, how will they be impacted? And I would say, can you speak to more the small business, since that obviously is the majority of businesses? What's sort of the forecast for small business? What does that rebound look like?
Well, so I just we don't have a specific outlook, but I think that it's important to kind of keep in mind the nuance of the pandemic. So small businesses obviously have been one of the most impacted sectors. A lot of sole proprietorships, whether it's restaurants or kind of the main service industries, those are areas that have obviously faced kind of the biggest pressures. So I think of the ones that survive, I think the outlook is obviously positive. And one interesting feature of the pandemic is that business formation has been extremely high. So unlike the global financial crisis, where we saw new business formation slow, we actually saw the opposite happen here. So I think it's kind of, again, maybe the pandemic forced people to take risks, and with that additional support from the federal government, we're able to start their own business. So with that, I think there's definitely a positive outlook. And then for the medium and large, I think it's obviously more a function of U.S. growth. So if you have strong U.S. growth and you're in a sector that's aligned with these more positive trends like technology, innovation, things of that nature, then obviously they're going to perform extremely well in the common environment. And as I alluded to, 5% GDP growth is around 2 or 3 times as high as we were experiencing during and after the global financial crisis. So that's definitely going to be a tailwind for those sectors.
Okay, I think this is going to be our last question, and Boyd, we may have lost John, so you may.
I think we have lost John. Yeah.
So you get to own this one. Do you expect a continued trend of businesses and individuals away from high tax environments of major cities such as New York and LA to lower tax states and cities such as Texas or Houston? So we've seen a big migration.
Yes.
Companies and businesses. Do you see that trend continuing?
The Elon Musk effect, right? This is yes. I think yes. I think there's obviously there's clearly issues associated with kind of higher tax states versus lower tax states. However, I think this tends to be a little bit overstated in a lot of cases. I mean, and I think, and this is one of the areas that falls victim to anecdotes. Elon Musk moves, and then they think half the California population is going to relocate to Texas. So I think it's about opportunities, right? I think Texas is a unique example of being a very low tax state, but also offering extremely strong opportunities for businesses. But again, I think this idea of major outflows from California has been a theory thrown out since basically the post crisis environment, but it's something that hasn't necessarily been a major sustained trend over the long run.
Okay, guys. First, I want to say a big thank you to you two. Phenomenal as usual this year. Especially impactful. So thank you so much, and much appreciated. Thanks to our audience for being with us and staying with us through the entire broadcast. Special thanks to the MIT Economic Forum for another outstanding event. Hopefully this time next year we'll be in person. So with that, I want to say thank you. Thank you to all the sponsors today, and everyone have a great day. We'll see you again 1 year. Have a great day.
Thanks, everyone.
Bye-bye. Thank you.